And now it's time to welcome back our favourite finance person, Rob Lees from Mortgage Choice Blue Mountains in Penrith, for our weekly finance segment. Good afternoon, Rob.
Good afternoon, Vent. Good afternoon, Diane. Favourite finance person.
Yeah, why not?
Thank you very much.
Just
what
for
a great
today.
compliment.
No,
just today.
Just for today.
Just today.
Yeah.
Yeah, you're our FFP. You're our FFP. Very topical discussion we're going to talk about today with the growing sort of issue about seniors being asset rich and cash poor, and whether the family home should or should not be assessed as part of the pension. The whole question of reverse mortgages is again coming into focus. So, Rob, how do reverse mortgages actually work?
Well, a reverse mortgage is simply borrowing money using your home as security. So it works like any other loan in that there's interest charged to the loan, but the difference between this kind of loan and the loans that we're used to is that you don't need to make payments. You don't need to make repayments as such. So the interest gets added on to the loan, and that is the big risk about it, the crunch with these, in that because of the effect of compounding over a period of time, it can become a very, very large loan. So if you started off with, for example, with a loan of about $50,000 and let's say an interest rate of 8%, that will become in 10 years a loan balance of $116,000. So what happens with these loans is that they're repaid either when the property sells, when you die, or when you move out of the property and into aged care.
So is there a possibility that the value of the loan exceeds the actual value of the property? Is that a conceivable outcome?
It can only go as far as being equal. So normally legislation requires that these loans, or the banks provide a guarantee that the loan will not be greater than the property's value.
But what about if property values crash in the meantime?
Well, that's the bank's risk. So if it gets to a point where the loan actually becomes more than the property value, the bank takes a hit on it.
So the situation, could be that the parent dies, and effectively the value of that major asset in estate is kind of neutral in the sense because
absolutely.
So
that's absolutely correct. So it could be that there is no inheritance left for the beneficiaries.
Okay, so any pros to the reverse mortgages?
I guess what it does is that it gives seniors access to cash that they wouldn't otherwise have, because they wouldn't otherwise qualify for a home loan. And look, there's situations. I'm not a big fan of the product, but there's a place for it, and probably more so in areas where there's some owner-occupied properties are worth millions of dollars. And you've got an aged person who's pretty much living in squalor. The house is falling down around them, and so they might need cash for emergency repairs on the property. They might need cash to access a lump sum to go into an aged care facility. They might need it for medical expenses or to buy a new car, or in some cases, they can actually use these to supplement income as well. Although I think you've got to be very cautious with that. So that's the positive side, access to cash.
Okay. Well, can we snuck one more track in, Vent?
I think we're going to be very tight for time, but let's see how we go.
All right, this is Ricky Lee Jones with Night Train. That's Ricky Lee Jones with Night Train. And we're back with Rob Lees. Rob, if more people enter into reverse... I'll start again.
I think we're going to look at the downside, weren't we? The cons.
The cons,
We'll sort of touch on that other question
All
anyway.
right, so we've talked about some of the pros, but what also are some of the cons of reverse mortgages?
Yeah, we've touched on a bit of this too, that the compounding effect means that you could get to a place where you've got no equity left. Also, just to say, the interest rates are higher, around about 8%. They're normally fixed rate terms, so if you do want to sell the house, the break costs are quite extensive. The other thing too that we need to be aware of is that if you've got someone else living in the home and you pass away, the loan has to be repaid and they could be homeless. So that also creates another issue as well. And I guess it just means that if you take these loans out too early in your life, let's say you're only 60 years of age and you live for another 30 years, it may be that when you really need to use the money, there's no equity left. So, there needs to be a lot of care about these, and a lot of advice that goes into it before you make a decision to proceed with them.
So proceed with caution is the word.
Absolutely.
Proceed with caution and get good advice, obviously.
That's right, absolutely.
Indeed. All right, Rob, well, thank you again for joining us on the show today. You've been listening to Rob Lees from Mortgage Choice Blue Mountains and Penrith, and you can contact them on 47399749 or visit their office at 3/13 Hope Street in Blaxland. And I believe, Rob, that next week Tim Hayman's going to come on the show.
That's right.
And you're having a day off.
That's right. So Tim, our financial planner, will explore some of these things, pension entitlements, and how that's affected your asset test and your income.
And I think critical issues for many Australians to start to get their heads around, given the demographic bubble.
Indeed. All right, so we look forward to Tim joining us next week. And that's pretty much all we have for the show today.